Okay, let's jump right in. Today, we're putting on our expert investment analyst hats. We're taking a look at a really fascinating cloud software company called Intapp, and we're going to run it through the ultimate gauntlet. We'll stress test its raw financial data using the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, and then follow that up with some modern discounted cash flow models. It's essentially the ultimate clash of old school value versus new school growth. Here's a quick look at our roadmap. We'll start with a company snapshot, look through the Warren Buffett, Peter Lynch, and Benjamin Graham lenses, crunch the DCF and quant models, and finally synthesize it all for a final verdict. Section 1, the company snapshot. Let's establish our baseline facts. So, Intapp, trading under the ticker symbol INTA, is a vertical software provider. Basically, they build highly specialized tech specifically for law firms, private capital investors, and investment banks. Right now, they're trading at $22.04 with a market cap of about $1.69 billion. They've got over 1,300 employees and are pulling in just over $504 million in total revenue. And their primary growth engine is incredibly clear. Their cloud annual recurring revenue, or ARR, is up a massive 31% year over year to $434 million. SaaS revenue actually makes up 73% of their total revenue now. What they're doing is successfully transitioning these massive professional services clients into high-margin, recurring software subscribers. Moving on to Section 2, let's look at this exact same data through the Warren Buffett lens. Now, through a Buffett lens, there's actually a lot to love at first glance. Intapp has a very real economic moat. Their software is just deeply integrated into the complex compliance and deal-making workflows of these investment banks. That creates incredibly high switching costs. Plus, it's heavily reinforced by this powerful Microsoft co-sell partnership, where Microsoft is literally chipping in Azure investment dollars to help close deals. But the financial reality presents a massive roadblock for Buffett. They're sitting on unprofitable GAAP operating margins of negative 3.78% over the trailing 12 months, and trailing net income is negative $18.22 million. Let's run down Buffett's exact criteria. Economic moat? Yes. Honest, shareholder-friendly management? Yes, they actually just authorized a $200 million share buyback to help offset dilution. But here's where the wheels fall off. Consistent earnings? Nope. Trailing earnings per share is negative 46 cents. And because we don't have explicit positive net income, we have to assume return on equity and owner earnings are currently negative. Buffett absolutely requires consistent, predictable cash generation, so at this exact moment, Intapp fails his consistency test. For Buffett, his required entry price today would essentially be zero until GAAP profitability is actually proven. All right, Section 3. Let's swap those strict value glasses for the Peter Lynch lens. Peter Lynch famously loved finding successful companies hidden in plain sight long before Wall Street caught on. And to do that, he popularized the PEG ratio to find, growth at a reasonable price. He didn't mind paying a higher PE multiple at all, as long as the company was growing fast enough to justify it. Ideally, he's looking for a ratio below 1.0. So let's do the math on Intapp. Using a normalized forward EPS estimate of $1.22, at a share price of $22.04, we get a forward PE ratio of roughly 18. Now, if we divide that PE of 18 by their massive 31% Cloud ARR growth rate, we get an incredibly attractive PEG ratio of 0.58. Anything under 1 is considered great. 0.58 is just fantastic. For Lynch, this makes Intapp a classic fast grower. And a bigger reason why is their cloud net revenue retention rate, which is sitting at a stellar 123%. Think about what that means. Existing clients aren't just staying on the platform, they're actually expanding their spending by 23 cents for every dollar they've already committed. For a Lynch-style investor, a high-retention, fast-growing SaaS company with a PEG of 0.58 is basically a screaming buy. Okay, Section 4. Let's apply the most brutal filter of them all, the Benjamin Graham lens. Graham's defensive checklist is notoriously strict. Does it have adequate size? Well, yes, it passes with a $1.69 billion market cap. But after that, it's rough. A modern SaaS company intentionally burning cash to capture market share completely shatters his required safety parameters. It utterly fails the earnings stability test, it pays absolutely no dividend, and obviously it fails the moderate price to earnings test. It gets worse when you look at Graham's famous intrinsic value formula, which is the square root of 22.5 times earnings per share times book value per share. Because Intapp's trailing EPS is negative 46 cents, This formula literally breaks mathematically. Even if we make generous assumptions for standard software book value multiples, you can't take the square root of a negative number. Graham demands tangible assets and current profits. So for him, this stock is mathematically uninvestable right now, demanding a price of 0. Section 5. Now that we've exhausted our philosophical lenses, let's pivot to pure mathematics with DCF and quant models. To build our base case discounted cash flow model, we're forecasting a 12.5% revenue CAGR out to 2031, and we're assuming margins will stabilize at a healthy 17% net income as they scale. Crucially, we have to factor in that $200 million share buyback, which reduces dilution. Then, we apply a standard industry weighted average cost of capital, or WACC, and a perpetual terminal growth rate to discount all those future cash flows back to today. The resulting math here is pretty striking. Our base case DCF generates a fair value of $36.30 per share. Even if you run a sensitivity table on that WACC, it implies a massive margin of safety compared to today's $22 price. And if you look at Wall Street consensus using comparable EV to EBITDA multiples, the most bullish models stretch all the way up to $58. But here's the ultimate wildcard catalyst deriving those high price targets: Celeste. This is Intapp's brand new agentic AI platform built specifically for professional firms. Why is this such a big deal for the models? Because Celeste shifts Intapp's billing from flat per-seat subscriptions to highly scalable consumption-based revenue. Basically, if clients use the AI more to check conflicts or manage their deals, Intapp automatically makes more money. Section 6. Synthesis and final verdict. Time to bring it all together. We've run the numbers and applied the frameworks, and our final breakdown perfectly captures the fascinating divide in modern investing. Traditional value investors like Buffett and Graham simply wouldn't touch Intapp. The lack of GAAP profitability and tangible book value violates their most sacred rules. But if you look at growth frameworks like Peter Lynch or our quantitative cash flow models, they see a massively undervalued asset. Let's weigh the balance. The strengths are absolutely undeniable. 31% recurring revenue growth, that incredible 123% retention rate, a buyback protecting shareholders, and a massive AI catalyst. But the risks are real too. They're still unprofitable on a GAAP basis, they rely heavily on Microsoft to co-sell their product, and if that retention rate slips below 120%, well, those DCF models are going to start breaking down. Ultimately, your investment thesis comes down to your personal risk tolerance. Are you worried about their transition to GAAP profitability, or are you focused on the explosive upside of their new AI tools? The management team certainly knows what's at stake. On their latest earnings call, CEO John Hall said of the new AI platform, "This is the single largest release that we've ever done." And honestly, if he's right, and Celeste successfully penetrates their newly declared $30 billion agentic workflow market, today's $22 share price is going to look like a historical anomaly. So what's our final synthesized verdict? It's really a blended one. For growth investors and quant analysts, this is a clear buy. That 0.58 PEG ratio and the $36 DCF valuation offer a massive margin of safety. But if you're a strict value adherent following Buffett or Graham, you have to rate this a sell or avoid and keep it firmly on the watch list until those trailing earnings officially turn positive. We've shown you exactly how the legends would value Intapp's data. We've crunched the math. But the ultimate question for you is this: knowing the risks and the massive AI upside, at what price does this stock hit your personal margin of safety?